Hey everyone, thank you for joining. Sorry for keeping you waiting. We're just connecting AirPods and things like that. Joe and I are in Paris this week at ETHCC, and Sid is joining from Miami. I think he's lonely over there with half of the team over in Europe. So he's really looking forward to talking to you all today because he's had nobody to talk to recently. So thanks for joining. Big update for you all this month. You've probably seen a lot of the content that we've been pumping out over the past 2 weeks, including the Q2 Treasury Report, which Joe will take you through today, and also the H2 product roadmap, which has been eagerly awaited, and there's lots of juicy stuff in there. So we're going to take the time to take you through some real core product updates, mainly Maple 2.0, which is just really going to transform Maple and growers into the future, help us scale into the future. And then Sid has today published a reflections piece on the past 2 months. It's been really hectic, both for Maple and the market, but Sid's just published a really measured piece about what we've been thinking and what we've been doing during that time and the road ahead. So definitely listening to everybody's recommendations and already planning that in as to into the project. So yeah, loads has happened since last time we've met, and hopefully you've all had a chance to read the comms that we've been publishing because they are really thoughtful and in depth. We'll try and break them out for you today. And yeah, let's go. Ask your questions in the chat. Already got 6 questions, which I think, that's good going. But keep popping them down in there, and then we'll field them at the end or at the end of each section. I think we can probably kick things off. Joe, you good to go?
I'm all set up.
He's in the background. All right, I'm going to pass over to Joe, and he's going to take us through the Treasury report. Here goes. Sorry, we're just getting Joe's headphones working.
Got to invest in a pair of AirPods.
Do you want to sit next to me? We can't get Joe's mic working. You can come sit next to me, Joe, maybe.
Okay.
This is a rare treat for everyone.
All right. So it's been a bit of mayhem. I've got maybe 3 different audio devices in the anyway, let's kick off. So, all right. You set?
That's that.
All right. So, as everyone would have seen, we sent out the Q2 Treasury Report, which I think I jokingly said on Twitter is the most eagerly anticipated crypto report now, as we've started producing it every quarter. So what we have produced is an overview, so everyone has full transparency on the platform, our normal recurring revenues and expenses, and that normal same level of transparency that we've tried to maintain across the organisation. And so what you've seen over the course of the last 8 weeks or so has obviously been a huge downturn in the markets overall. The platform itself and Maple itself has performed really well, and we've been pretty proud of the effort that the team's put forward. And so within that context of the market downturn, and we saw the industry shrinking by 67% or 2/3 overall. The liquidity quarter on quarter from Maple only shrunk 12%, and so that's been maintained through the fact that there were more of a term loan product, and that we're lending to some of the most creditworthy companies in the space. The smart contracts have maintained throughout the entire period, going through was probably going to be their most stress test scenario, and we've still throughout the quarter been able to maintain significant growth in loan originations, and so some really strong numbers across the board there. We issued over $400 million in new loans, which was across 7 pools. We obviously saw the launch of 2 new pools on the Solana ecosystem, which was a strong contributor to our growth throughout the quarter. And that culminated in us getting to 1.5 billion in loans originated, which was a big milestone for the team. And then, as you can see now that we're starting to accumulate more and more capital onto the platform, the interest starts to flow and accumulate it in a much larger way. And so we had $17 million worth of interest repayments come through the platform, which is roughly around half of the interest that's ever been paid out through the Maple protocol. We then also saw unique lenders continuing to increase, with unique addresses coming into the pools, 25% growth there. And then one of the metrics that we're really proud of is since the launch of Maple, we've seen a real uptick in people coming back to the platform and upsizing their deposits. And so you can see nearly a quarter of lenders onto the platform return to the Maple platform and then upsize their initial deposit by nearly 3 3/4 times, which is a significant upscaling amount. All right. Then so went through most of the numbers there, and you can see that total active liquidity remains at around $750 million on the platform across both Solana and Ethereum, and that's a slight decrease due to the current market conditions quarter on quarter, but is down from all-time highs of around $950 million from a couple of months ago. Then in terms of a breakdown of revenues, so as most people know, and we continue reiterating, is that the business model of Maple is through loan originations, and that's where our revenue comes from. So all of the revenue is born or comes from the cost of the borrowers. And so every time a new loan is originated, that's when revenue is generated for the platform and returned to the Maple Treasury. And so obviously across the course of the last 2 months, we haven't been able to issue as many loans as we would have liked, and that's a core focus for the team over this quarter, is getting back to issuing new loans and returning to getting revenues into the protocol. With the launch of Solana, we saw obviously the Genesis pool and then the X margin pool. We got to over $100 million on the Solana platform, with more than $100 million of loan originations, and so the revenue started flowing in from there, and we saw already over 100 grand's worth of revenue come in from the Solana ecosystem. Then looking at more of a breakdown of the full profit and loss of the business, as you can see that expenses continue to grow across the platform as we invest in bringing on more and more people. So we're a people-heavy expense structure, and that's 75% of our expense base is through the people that work at Maple. And over the course of the last 6 months, we've really ramped up the significance of our hiring efforts, and we'll come back to questions in a second. We've really ramped up the expansion of the team with some senior hires coming into our structure. So in Q1 we hired a head of product and a head of engineering. In Q2 we've hired an operations manager, and then someone to lead sales efforts as well. And so Q2 numbers show the full impact of those hires in Q1, and then obviously the new hires that have come on throughout the quarter. And what we're investing in is ensuring, one, that we have a strong commercial business that's able to facilitate the growth of the platform from a commercial perspective, but then ensuring that we're also developing the product delivery engine with a strong ability to build and ship new products. All right, and there's a more detailed breakdown of the expenses there, and as you can see like 1.7 million of a total of 2.1 million in expenses comes from the team costs. And then, the main probably upside that we missed on budgeting, because budgeting across the board is pretty good, is around smart contract audits, and so that'll just be a little bit more delayed. We shipped XMPL, and so there was smart contracts that were in Q1, smart contract audits that were in Q1, and there'll be significant smart contract audit expense in relation to V2 of the protocol coming out, which we'll go through in the roadmap. Charlotte's meant to say this, but you can read the full report on our website. All right, Sid, over to you to run through some roadmap things.
Yeah, thanks, Joe. So if we look at what we shipped in the first half of the year, so we had a pretty strong first half in terms of building foundational work that puts us in a good position for the long term. So on the business side, we reached the significant milestone of hitting 1 billion in cumulative loan originations since launch. And then in Q2, we accelerated this, reaching 1.5 billion before the end of the quarter. And then on the product side, we were able to ship Maple Solana. So that was a big win at the end of April. Really proud of what we're able to launch there with X Margin and Genesis. And then we're able to also ship XMPL, which introduced staking MPL outside of just in pool cover. And this was, receiving a portion of MPL back, which was the release of establishment fees. And then we've also just recently shipped the refinancing feature. So I think we'll go into this in a little bit, but this refinancing feature will be really important for us because it gives us the ability to shorten the loan duration. So, previously it was a pain in the ass for borrowers to repay loans, and this meant that it was pushing us to 3 and 6 month tenors. Whereas by being able to do this really easily, we'll be able to shorten loan tenors to 1 month and 2 months, as well as even down to 14 days, so that we're easily able to reprice them and have loans that mature quicker, so we can facilitate more withdrawals if we need to in times of volatility. So moving on to the Q3 roadmap. What we want to achieve is to grow Maple Solana. And really one of the things we're trying to achieve here is not just a clone of what we have on the Ethereum blockchain, but we want to add unique features that really differentiate it and expand the use case of what we're able to do there with crypto lending. So we want to reach new markets, and we're trying to do this by adding features that are going to be unique to Maple Solana. So open term loans are one. So this is, these are more commonly used in a lot of institutional lending businesses where you have the ability so the delegate will have this ability to call loans back with a couple of days notice, and this can be used to better match asset and liability duration. The other thing we'll try and introduce will be active collateral management. So this will make it, it'll give delegates the ability to require collateral from borrowers, but to adjust that ratio over time so that they can manage the risk. So if there is a period of significant volatility and there was a borrower who had maybe 50% collateral, well, if that collateral drops in value, the delegate would be able to increase it and maybe require a top up back to in Q3 at the launch of some pretty differentiated and unique pools. So what we want to do here is launch a pool that's going to be catering to financing the crypto mining sector. So we've talked about this for some time. The market volatility in Q2 pushed back timeline here a little bit, but we are going to be delivering this in Q3. So we are having good conversations with a couple of potential pool delegates and early conversations with potential borrowers, and the growth team's on track to launch this during the quarter. We're also in talks with delegates around potentially launching into a new sector, which would be more focused on SaaS companies and potentially fintechs, which is part of our push to get beyond the very volatile crypto sector. So when you're lending to market makers in times of volatility, reach new industries so that we have a diversified set of borrowers who are less exposed to the overall macro conditions within, or market conditions, I should say, within crypto. So pretty exciting conversations there, but stay tuned. For Q4, we're going to be trying to ship more new features. So with a product heavy emphasis in Q4, we're going to be looking at things like reporting and accounting for our institutional depositors who have fund admins. Those fund admins currently do a pretty heroic job of trying to work out things like impermanent loss, mark to market, and accrued interest. But what we're going to do is issue a dashboard that just makes that really, really simple. And it's requests that we've had inbound from some of the big four auditors, as well as some of the big institutional depositors on the platform. Once we've got some of these foundational blocks in place, Maple is going to be a true one-stop shop for anyone who wants to access credit markets on chain. And then we're going to go into Maple 2.0 on the next slide, but this is obviously the really major thing that the engineering team is working on. Go for it, Joe.
All right. So, yeah, Maple 2.0 is, as Sid said, the most important initiative. I think Graham, who's our product manager, labeled it as the most important feature set that he's going to, important technical initiative that he's going to launch in his career. So it is a huge focus of the team, and everyone's really buckled into finalizing scope and finalizing the build over the course of the next 4 to 5 weeks before our first audit commences. And so what Maple 2.0 at its heart is a fundamental overhaul of the current smart contract infrastructure. And so when we launched Maple back in May of last year, it was obviously with a fixed set of parameters around how we wanted the protocol to operate. And it's been able to enable us to go from zero to where we are today with issuing 1.5 billion in loans. But Maple 2.0 is going to enable, and we'll go through the specifics of it, but enable us to scale into the future. It's going to take us from where we are today with a much more flexible infrastructure to be able to scale and meet customers' needs across our market. And so to touch on the main points of what Maple 2.0 is going to enable and some of the features that it's going to introduce, it's under 4 main headings that Charlotte's outlined here. So one is that it's going to be iterative. And so currently, if you think about the smart contracts, we've done many updates to the loan smart contracts because loans roll off and then they can be issued again with the new contract. The pools contracts subsist because a pool is evergreen and is existing for a long period of time. And so therefore, we need the ability to be able to add features and add loan structures and be able to have flexibility for the pool delegates to grow and operate their pools in different strategies and structures. And so what that looks like is overhauling the base infrastructure that the contracts operate with and stripping out a lot of the logic and to be honest, mistakes that I made in the scoping of the product in the early days. And so we've learnt a lot over the course of the last year, and we're now able to incorporate those learnings, and especially a lot of the learnings of the last 6 to 8 weeks into Maple 2.0, so that we're able to serve customers' needs even better. The next thing that's enabled is interoperability. So currently, you don't have the ability with the pool tokens that are produced or any of the tokens that are produced throughout the marketplace to be interoperable with the rest of DeFi. And so we're going to be moving to the 4626 standard, which we introduced with XMPL. And so that'll enable compounding tokens. So one, there will be the benefit of compounding your interest that you're earning on participating in Maple, as well as then be able to interoperate with other protocols in the space, build out secondary markets. And so it'll just enable a lot more flexibility and potential for development and partnerships down the track. Then from a flexibility standpoint, we're going to enable and transfer a lot more flexibility down to the pool delegates to enable longer term scalability. Because if you think about Maple and the way that it scales, we bring on more and more reputable pool delegates that have larger and larger access to capital networks to enable the scalability, and they're using our infrastructure. And so investing in the development of our infrastructure is what we're doing with Maple 2.0, and this will enable different sets of borrower verticals, different strategies for the pools, different loan structures, as well as then updating things like our withdrawal mechanism so that people are able to have shorter or longer term liquidity needs met, and enabling pool delegates to structure their pool in the way that they see fit. And then finally is around cover. And so there's been a lot of talk around cover and the mechanism. And we recognize that the way that it was set up was not ideal from a customer experience perspective and from the things that it doesn't enable. So we saw, obviously, it enables or allows impermanent loss to exist. And it's just a bad customer experience where you have to leave the platform to go to balancer, then return to deposit into cover. And so we'll be moving to single-sided cover mechanism, which will enable larger participation in cover, but then also direct liquidation of cover and removing that impermanent loss hurdle. All right, and then I'm sure people have some questions which we can get into later, but back over to Sid for some reflections on the recent times.
Thanks, Joe. Yeah, and I've been taking a note of all the questions, so we will cover them in one hit at the end. So dipping into some reflections on how Q2 went. So I think it was definitely a time of extreme volatility, probably understatement of the century. But kicking it off, started relatively normal, and then as we got into May, there was obviously a lot of turbulence resulting from Luna. So, the unwind of the anchor trade, obviously impacted a pretty broad set of people within the space. Our loan book was actually relatively unaffected, and that's because Maple's borrowers are primarily high frequency traders as well as market makers, but they tend to be delta neutral hedged. And so they weren't really playing the anchor trade, which was, of course, a carry trade, but a relatively simplistic one, which was mostly favored by some hedge funds, VCs, and of course, ultimately retail. So anyway, once that unwound, the delegates had to spring into action, and the major impact that we actually saw was an initial spike in withdrawals that were coming off the platform, but we found that most people didn't end up converting. So it was definitely less than a 30% conversion there. And things actually returned to a sense of normalcy pretty quickly. So we're able to continue writing loans out of both of the major Maven and orthogonal pools. But then what happened is it did coincide with a lift in withdrawals coming out of the CeFi lending platforms, as well as a broader decline in asset prices. So this culminated in early to mid-June. Celsius froze withdrawals, as well as some of the other large CeFi lenders, and 3AC was found to be insolvent. Now, this triggered an initial wave of contagion risks or contagion fears, which was kind of unique in that it wasn't particular to the retail side of the market, that it was also a lot of institutions who had these concerns. So for us, the main impact was supply side. We initially started seeing elevated requests for withdrawals, but unlike previously, we're actually seeing a lot of conversions of these withdrawals. Throughout the period, the borrower loan book health actually remained pretty good. So as I mentioned in a Twitter thread, going into June, we had about 755 million in loans outstanding, and over what was a very extreme period of volatility, there was only a single default, and that was $10 million loan to Babel. So on loans outstanding, 1.3%. So we performed markedly better than most of the other CeFi lenders in the space. But how this unfolded was once withdrawals were frozen from Babel, the delegates started reaching out to them, began a dialogue with management. That then proceeded to the liquidation of the Babel loan when they weren't able to meet the interest payment. And this is where we saw one of the learnings. So cover didn't have enough liquidity due to some constraints on the maths of how balancer works. And that is that you're only able to withdraw 1/3 of the USDC leg of a balancer pool. So whilst you have a balancer pool that was covering multiple pools on Maple, going back about 6 weeks ago, it had substantially more liquidity. But when it came time to liquidate the loan on the platform, it was reduced asset value in there. And that meant that we were constrained in how much USDC could be returned to the pool. So ultimately, this resulted in about a 3.2% haircut applied across lenders in the pool. And so that was about 7.8 million in value on top of a pool balance of 244 million. So what we learned from that is, that we're going to improve the cover mechanism and make it single-sided so that we can increase the efficiency there. But Orthogonal, as well as the Maple Foundation, do have legal recourse. They are going to pursue recoveries, and any recoveries that are made will be distributed to lenders who are in the pool at the time of default. So that'll be done through an airdrop mechanism of some kind for anything that's made there. But what we want to get to now is returning to a focus on growth. So we continue to see good opportunities to deploy capital in this market. And what we're seeing is that the borrowers, so the market neutral ones, which include the likes of Wintermute, Amber Group, as well as Folkvang Nibio, all performed pretty well over the period of volatility, and they actually enjoy trading volatility. So their profitability goes up in periods like this, and therefore, when you combine this with the fact that their lending supply was reduced by more than half because all of the C5 players ceased to do new loans, it's meant that pricing opportunities for a platform like Maple have markedly improved to the point where you're seeing opportunities to deploy at kind of mid double-digit rates. So we're keen to get more deposits back in. That's been our main constraint. And so we're looking at opportunities like, can we get more delegates on the pool? More delegates on the platform? Can we launch new pools? And that's currently a focus. So as soon as withdrawals slow down, this will enable the delegates to go about originating new loans. It wouldn't be responsible to do that whilst there is still a large queue of pending withdrawals. So that's why we're exploring opportunities like launching a new pool, whether it's permissioned or whether it's focusing on a new sector. So I think one of the things that's been really impressive here is that we've seen best-in-class underwriting from the delegates. So, we saw pretty good updates put out by both Orthogonal and Maven, which covered in detail the health of their loan book. It included aggregated metrics on things like debt to assets, and the balance sheet health of some of the borrowers in the pool. And it's part of our initiative to provide more transparency to lenders who are on the platform. And this is something that we want to continue as well as expand over the next quarter. So expect to see continued updates from delegates as well as commentary. And this, one of the things we've been talking about is even doing maybe a market update call where the delegates would provide some of the insights that they're seeing. But we're also taking away lessons on areas that delegates can improve their underwriting standards regarding, whether it's the quality of reporting provided by borrowers or the frequency with which it's provided. And reiterating now, our objective for Q3 is to get back to growth. We want to reach 1 billion in TVL. To accomplish that, we're going to focus on returning the existing pools to net positive lending capital, as well as launch new pools with the existing delegates, as well as new pools with new delegates in borrower verticals that I mentioned, whether it be BTC mining. And the advantage of underwriting BTC mining loans at this period is that it's bottom of cycle, so you can apply the best terms and you can cherry pick the best borrowers who have fared okay during this period of volatility. And the other vertical being SaaS and potentially fintech borrowers. So I think we can go to, so lessons learned. So we do want to implement changes quickly to improve the withdrawal process. I know this has definitely been a pain point that people have commented on in Discord and in direct feedback to the team. So what we're looking at is firstly a UX update that will provide more clarity on when liquidity is becoming available. So what this will look like is something that shows liquidity available over next periods, whether it's 10 days, 30 days, 90 days, but it's going to be taking into account the requests and kind of the pain points that the community have voiced. And then as we move into Pools V2, some of the redesigns that have been scoped in to take account of the feedback that people have provided is going to be pro rata withdrawal mechanism, so that there's no incentive to try and front run other people. People will be treated equally during a withdrawal period, and it will just be weighted by the balance that a given depositor has in the pool. We'll also be looking at single-sided pool cover, so that we don't have the complexity of an LP token, as well as the wrong way issue of when there is a market downturn, the value of pool cover can decline, which is when you actually want it to be most steady. And these are all going to be released in Maple v2, which team is scoping. We do have a soft target of achieving an audit before the end of the quarter, and we'll be looking to roll that out before the end of the year. With that, I think I'll pass back over to Charlotte or to Joe.
Me. I got my job back. So that's a lot of information, and hopefully you will have time to read through the long reads that we've published for both the Q2 Treasury Report and the H2 Roadmap as well. And Sid has just today shared a long and thoughtful piece about his personal as well as the business, like what's going to be happening next, basically. But all of that has been shared and can be found on Twitter and also on our website. So do give those a read for more detail. And I guess for now we can just throw it over to Q&A. It's about 10 questions that have come in, and let's get that going. If you have any more questions, then keep popping them in. I'm going to start I'll start from the top. So with the default of Babel in the Ortho pool, there's been a little bit of bad sentiment, perhaps, but what have we gained from this experience? And I think Sid did cover that earlier. We are absolutely listening to people. We are reading every single message, and we do talk about them, like Joe said, as a team all the time. And I think we've got a clear path forward now. We've identified the areas that we do need to look into, and we're now scoping those out and plugging them in. Sid, would you add any more to that based on conversations that you're having?
Yeah, for sure. I think the key pain points were clarity on liquidity availability, and so that's something we're going to tackle as a UX feature. And then the other one was, I think, fairness of withdrawals. So that's one that'll be a product fix in the smart contract. So because it's in the smart contracts, it's not something that can be deployed overnight, but that is going to be addressed by doing pro-ratering of withdrawals. And then the other element is just improving the cover mechanism. So having that be single-sided. So these are all things that are going to be introduced in Pools v2. The thing to note about Pools v2, or rather Maple 2.0, is that it's kind of like a platform. So before, if you wanted to make any change, you would need to wholesale redeploy the entirety of the protocol. Whereas with this upgrade, it's like having pieces of Lego that we can sub in for various parts. So if we want to improve the way liquidations work, we can update that one piece without having to redeploy the whole protocol. So it's going to be a huge advance in terms of our ability to iterate and improve on designs. Are you on mute? Okay. That's all right. I'll keep reading the questions out. So, credit underwriting right now is a black box in the hands of the underwriter. Are there plans for increased transparency for lenders? So I think the important thing to note is we're happy to provide transparency on how the delegates underwrite, like what they look for. But if the request is transparency as to what are the financials of the underlying borrowers, that's not really in the scope of the product we're trying to build. It's more like anyone who comes to the platform has the choice of choosing a pool. They can transparently see the entire performance of that pool. They can see who's underwriting, and if they want, they can pose questions on how the delegate underwrites. But we're not trying to set up a platform where everybody goes and individually underwrites all of the borrowers on the platform by looking at their financials. The problem there would be that it poses adverse selection, and that the borrowers you would get coming to the platform would be those. Can you guys just go on mute? would be those who have challenges getting credit elsewhere. So, the borrowers who are performing well value confidentiality in their financials. So hopefully that answers that question. I'll just keep moving on. How do you feel about the usage and expenses so far? Do you think it'll continue to use the same amount of expenses in the next quarter, or will it be much less? Joe, do you want to field that one?
Sure. Yeah. So in terms of expenses, as we said, people is the major cost base, and whilst we, so our main thing is that we never want to be making retrenchments. We did have quite strong growth objectives around the number of people that would be joining before the end of the year, which we've definitely scaled back given the current market conditions and the uncertainty that a bear market brings. So we would expect the expense base to remain fairly consistent throughout the next 2 quarters. And we've gone through a budgeting process or re-budgeting process for the rest of the year, with the team, with each department mapping out things in great detail so that we've got as much visibility on what's coming up and making the necessary cuts or refinements that need to be done to be mindful of costs moving forward during a bear market. We do have significant volumes of stablecoins in our treasury, and so we're reasonably comfortable with the burn rate that we currently have, and that we'll be able to move forward into next year, even in the worst case scenarios, without having to raise money or worrying about our run rate. There's also another question around financials financials provided a helpful understanding cash flow, but they aren't a complete picture of profit and loss. So I'm assuming your main thing is around the MPL rewards that are being distributed, and so understand that technically should come into a pure profit and loss. We are representing this more as a cash flow, given that the treasury is denominated in USDC. But I think potentially we can do some more reporting around the run rate on MPL and where that sits, so that there's a more complete picture for everyone. And I would say more broadly that we are, as everyone has seen over the course of the last 6 months, significantly tapering down our rewards program. And the idea is that we get to a point in time where the rewards are only used at the outset of a pool to bootstrap growth and be used to facilitate maybe some OTC transactions to strategic investors that are launching pools or participating in the protocol, but not be this ongoing rewards stream that's going out to all of the pools, and that the yield being generated by the pool itself and the underlying cash flows of the borrowers is all the yield that's provided on the platform.
Cool. All right, and then I think we can jump on to the next question. And Sid, I'm going to throw this one to you, because it's a commercial question about crypto mining pool and how close we are to bringing on that new borrower set to Maple.
Yeah, good question. So we are very close. So we've at the stage where we're inking agreements with 2 pool delegates, and then they have an initial target list of borrowers to go out to. So if I had to put a bracket on it, I'd probably say it's late August, early September that those first loans should go out the door. But definitely still a sector we're interested in lending to. I mean, a lot of people might have been put off given the challenges that the sector's faced. But I think, if you're underwriting at the bottom of a cycle to a sector, one, you see the borrowers at their potential worst, you get the best opportunity when it comes to pricing, and also putting in place tight covenants to protect the position of the lenders.
Yeah, exactly. And then I think a similar question, probably a little bit further out, but definitely on our radar, regarding lending to fintech companies, because we keep talking about it, but someone here is asking for an update on that. So if you could be more specific.
Yes. So like a fintech pool is also on the cards. This would be fintech or SaaS, but either way, the key piece of the key requirement is that it be outside of crypto. And so what we're looking at here is, could we launch one of these pools before the end of the quarter? We're in ongoing discussions. That one's a little bit, it's a little bit different because the challenges are you need to have something in the way of an off ramp as well, so that those borrowers can take stables and then convert them to fiat for their expenses. So that is definitely something that we want to pursue as a strategic goal, and we'd be looking to launch that before the end of the year. Ideally, we push the team for sooner, but those conversations do take time. I can also dip into the one on borrower interest rates. So how do you think about what the appropriate borrower interest rates are? More directly, are current rates high enough for their credit risk and collections recovery servicing risk? Note that the TradFi high yield is around 7% and junk is around 15%. It's a good question. So I think rates in this sector were close to that high single digit rate before. Now I would definitely say they're in the double digit range. But I think the thing to keep in mind, so we do try and look to benchmark these against like high yield rates. And so I wouldn't see, like, of the new loans that will be going out over the next few months, I think it'd be challenging to see any borrower qualifying for a high single digit rate. And I think it's most likely to be in the low double digit range. What we found is that, if you're able to, I think rates were probably compressed before by a market in which a lot of CFI lenders were going after growth, and they were doing that by originating loans at kind of at or below the rate that they were paying out to depositors. And so I think with that supply coming out of the market, rates will reprice more towards a commercial level. And I suspect that the right clearing rate for this kind of market is in the in that low to mid double digit range. I think a lot of borrowers are probably used to honeymoon type rates for a long period of time, and we're seeing expectations be adjusted there. So we'll say Maven are looking to launch a new pool, and the kind of target rates there would be like a low double digit handle on that in USDC. Credit agreements.
This is a Cosmo question. Can you tell?
I can.
So I'll read it out just for I'll read it out just for everybody. But Cosmo's asking about credit agreements and whether we'd be willing to share those, so that people can better understand the maintenance covenants and the method of recourse, and Sid can talk to that.
Yeah, sure. So, I mean, at times we've shared agreements with people who are doing large deposits, but ultimately it is kind of IP on the platform. And so it's not something that we want to share too widely, because the next person who goes to copy paste a credit protocol is just going to take those documents and use them. But we are happy to talk to the types of covenants that will go into them, as well as, requirements around information sharing and reporting by borrowers to delegates. It does also harm the ability to negotiate agreements where you have, when you're in commercial discussions with borrowers and they're pushing back on certain terms, you don't want to be in a position where they can say, oh, well, this borrower had this term, and, therefore I should be getting the same one. But we do try and have them standardized, because part of the value is that a borrower comes, executes one agreement, and they can borrow from multiple pools, subject to going through the commercial and credit due diligence with the delegate. So hopefully that answers your question, Cosmo, but I think it's more a case of us talking to the types of requirements that would be in there and covenants, rather than sharing the explicit agreements to one and all. Solana financials. So do your expenses include Solana team expenses? Is it right that MPL will receive 40% of syrup? And if so, is it more appropriate to not consolidate Solana revenue plus expenses? Joe.
Yes. So that is a all-in across the board P&L. So it's showing revenue for Solana, and it includes all of the expenses for Solana. What we haven't done is broken out a separate Solana P&L. And so We will do that moving forward. So I'd say from next quarter, we will look to break it out, given that we've expanded the team a little bit on the Solana side now, and it will be, and we're also looking to hire a financial and operations manager who will be able to get into more detailed reporting and things like that. And so we'll be able to provide next quarter a Ethereum-based P&L, a Solana-based P&L, and then a combined profit and loss across both chains. And yes, it is correct that that MPL holders, or the MPL Treasury, owns 40% of the Syrup tokens. We haven't minted the Syrup token, so it doesn't actually exist yet. Just in principle it exists, and that will be something that we factor into the roadmap over the course of the next 6 months or so, when we want to mint that Syrup token. And obviously when we do, we'll provide much more details around how that's all going to work.
Cool. Okay. So then I've tried to be organising these questions. So now we can go in to talk a little bit deeper about withdrawal queue, because I appreciate that that is affecting many of you. So we can take it from the top. I think we've covered most of it anyway, but we'll answer these directly. So are there plans to make the withdrawal queue more transparent for those who don't know how to read smart contracts? For just better transparency. Sid, do you want to take that one?
Yeah, I'll take it. Can you just hop on mute? Yes. Okay. So what we want to do is we do want to make the withdrawal queue more transparent. So the way that it works at the moment is that anyone who triggers a withdrawal goes into a 10-day cooldown period. And so what we'll do is show the aggregated amount of withdrawals over the next 10 days, as well as a summary of incoming repayments over a period of 10 days, 30 days, and 90 days, because I think some of the feedback has been, how do I know that I'm going to get my money out in the next 30 days, or what are the odds of doing it within the next 3 months? So I think we want to provide that clarity so that people aren't stuck in this cycle of just hitting trigger withdrawal, waiting the 10 days, and then they have their 48-hour window. They get frustrated and they do it again. It's a bit of I appreciate it's a frustrating cycle, and we've been listening to the feedback. So we're thinking about how we can improve that from a UX perspective. Level setting investor expectations based on the current withdrawal queue. On what date do you expect withdrawals to end, and thus for loan growth to be able to begin again? So I think we have a rough parity. Certainly in the Maven pool, withdrawals are much lower, and so I think within 30 days they'll be in a much better position to go back out and continue lending again. And we are, the Maven team are looking at launching a permission pool, so that will also give them an ability to go out and start originating again. With the orthogonal pool, there's a more closer parity over a 30-day period between withdrawals and repayments of loans. And so I would say it's more over a 30-day period that we might see that settling out. What we've seen as well, and it is tough to predict the decay, or rather I should say the churn of people who are re-upping their cooldown period, because that's settled a lot as people have gotten comfortable there aren't further contagion risks in the space. And so I think what we'll hope to see is a lot of those triggered withdrawals start to reduce over the next 30 days as people regain confidence in the space and are willing to leave their funds in those pools. Anything you can say about the upcoming large maturities for Amber and Wintermute? So just paraphrasing this question, I think giving more confidence that the worst of the credit contagion is behind us, with no defaults to come, will stem the amount of withdrawals and allow the protocol to return to growth. Also, if delegates feel good about credit, having them increase pool cover stake much more significantly would be helpful. So I think us and the delegates have been in pretty constant contact with Amber and Wintermute. So those are larger maturities coming due. Those borrowers performed very well, and indeed they do favor periods of volatility, as have been observed over the past few weeks. So those have been extremely profitable trading times for them. So Orthogonal has put out an update, as have Maven, but to paraphrase it, broadly that the health of the current borrowers in the pool is very good. So they will manage to maintain delta hedging as well as their market making activities. A lot of them did repay a substantial amount of loans, both to us and to other lenders who were financing them over the last few weeks. And so they have appetite to continue borrowing, and they are proceeding with business as usual. So I think hopefully those updates are starting to to alleviate people's concerns. But we and the delegates will continue to provide transparency around loan book health. But for us, we are more looking at kind of licking our lips at the opportunities at the moment to go and lend to these borrowers at pretty healthy rates and be quite choosy about who borrows from the platform. For the delegates, keep in mind these delegates are also looking at adding new pools, so there will be an initial cover requirement for either launching new pools that they have to keep in mind, rather than just continually topping up. I should note, Orthogonal did top up an additional $1 million into their pool immediately before that Babel loan was liquidated to enhance the cover that was available to people.
Cool. I think that's all of the questions from the main question area, but there is one last one from Paper Imperium talking about pool cover and whether there are any plans for other mitigations like guarantees or buybacks that the pool delegates are thinking about.
No plans at the moment in terms of buybacks. I think the thing to note is that what's being built here is a credit protocol where it is the lenders, who are taking credit risk. Delegates underwrite it. They put some skin in the game in cover to align their interests, but it is a credit protocol after all. It's not really possible to get around the fact that people who are lending in the pools are receiving a yield to take on credit risk. So we can look at various mitigants for it, but ultimately the goal is not to just shift the risk there. Or rather, I should say, the goal is not to just kind of backstop any defaults there. It's like we can mitigate it to some extent through diversification, through mechanisms like cover, but ultimately the yield that is priced into these loans does underwrite for some level of defaults happening. Typically in an institutional platform, you might underwrite to maybe like a 1 to 3% probability of default there.
Amazing. All answered. We're also getting lots of questions in Discord as well, so do keep them coming. We do take time to look at them and get back to you. If anything crops up, let us know, and we'll come back to you either in Discord or in Telegram. We'll host this again next month. I would suggest reading these in-depth pieces. They're good reads. Read them at the weekend or whenever you get time, because they're a bit long, but there's lots of juicy stuff in there. Once again, thanks for joining. Let us know if you need anything, and we'll chat to you in a month's time. Au revoir.
Thanks, everyone.
Thanks, guys.